working as a financial aid, working as a financial aid director and financial aid counselor. So a lot of my background is actually around student financial aid, which is why I work in student lending with PNC. So if you have questions along those lines, in addition to the counselors at Anne Arundel and any school that you may be attending, I'm always happy to answer questions as well. So today we're going to talk about credit scores and credit reports. Basically your credit, okay, this doesn't, I always have issues with this. Hang on one second. There we go. Okay. So your credit can have a big effect on your financial life. Your credit report provides a snapshot of your financial habits that financial institutions, cell phone companies, credit card companies, and others use to get a sense of your credit worthiness. So understanding how credit scores and reports work can help you to keep your finances healthy and also help you to achieve your financial goals, such as buying a home, leasing a car, or purchasing a car, or paying off debt. So before we get into why credit scores are important, just want to point out the goals of this workshop today are importance of credit scores and credit reports, learning how to access your information about your credit score and report, discuss some strategies to build and improve your credit, because even if you have good credit, you can always strive to improve it, and to identify how to protect your credit from incorrect claims and fraud. Oops. Yep, it just does not want to go easily. All right. So before we really get into why credit scores are important, let's discuss what they actually are. So a credit score is a 3-digit rating that tells a lender how likely you are to repay a debt. Different lenders use different criteria to calculate it. So depending on the type of loan that you might be looking for, you might have a different credit score attached to that particular product. Because if it's a secured loan, which is something that's tied to something tangible like a house or a car, or if it's an unsecured loan, such as a credit card or student loan, those are going to have different amounts of risk attached to them. So there may be slight differences in the credit score around different types of products. Poor credit is a score that's less than 600. So on here it says less than 579, but usually it's about 600 or less. People with a score of 600 or below could probably use help to rebuild their credit history. Fair credit is between 580 and 670. So in this range, it might be difficult to qualify for loans. And I apologize, I'm not sure why I'm having 600 on one thing and 579 on the other, but essentially anything under 600 is going to be considered not that great. So in the 580 to 670 score range, it may be difficult to qualify for loans. If someone with that score does get a loan, it may have a very high interest rate. Good credit is considered between 670 and 740. So if your credit is between those numbers, you might have blemishes on your credit report. There may have been some times when you were late with payments or missed a payment or something. And you might be restricted to higher than average interest rate on loans, but it won't be the worst, highest interest rate either. Very good credit is between 740 and 799. A credit score in that range is very good. You'll qualify for most loans. You probably have a solid credit history with maybe a missed or late payment on occasion. And your credit history also might just be shorter. People with a shorter length of time establishing their credit, they might not have as high of a score simply because they haven't established their score. They haven't established credit all that distant in the past. The longer the credit history, the higher the credit score possibly could be as well. Exceptional credit is anything over 800. That's going to be a person with the strongest credit history and a person who qualifies for the very best loan terms and interest rates. Your credit score can be poor, fair, good, very good, or exceptional. But what if you don't have any credit score at all? So many people, especially young people or people who are newly immigrated to the United States, have no credit history. That's not a bad thing. It's not the same as having bad or poor credit, although people without credit are also going to face similar difficulties in getting loans or proving their credit worthiness. There are some steps you can take to start building credit if you have no credit or a short credit history. The first is to open a line of credit. It could be a credit card through a bank or a retail store. It could be a small loan that you pay on time and in full. Special products such as secured credit cards and credit builder loans are designed to build your credit, but they might have restrictions on how much money you can borrow, and it might require you to put down cash collateral. So a secured credit card is basically a credit card. You use it like a credit card, but you're putting your own money into it. So let's say that the credit card, you go into a bank and you get a secured card and you put $1,000 into that secured card. $1,000 is your limit. And the credit card company is going to report that credit the same way it does any credit card at all. But you're putting skin in the game, basically. If, for someone who's recently immigrated to the United States, they'll need proof of address and some form of government issued identification, such as a passport or their foreign identification. The second step is request that your payment history be reported. If you pay your rent and utilities on time, you can request that your landlord or utility company report your positive payment history to credit bureaus. Keep in mind that they are not obligated to do so, even if you ask, but it doesn't hurt to ask because that can help with establishing your credit. The third step is open a joint account. Now, this is something that you want to take kind of with a grain of salt. You can ask a family member or a friend with good credit to co-sign on a loan or credit application, but you have to keep in mind anything that you do with that account, if it's co-signed with someone else on it, it's going to impact their credit as well. So any joint accounts, you really want to make sure that you are always paying on time. And you want to make sure that those get reported to the credit bureaus as well, because that's going to help your credit, excuse me, and it could also help the credit of your cosigner. And the fourth thing is to pay all of your bills on time and in full. Never, ever miss a payment. If you think you might be late or about to miss a payment, you want to reach out to the creditor and see what options are available. And this is where a lot of times people get into a lot of trouble because they think, oh gosh, I'm going to miss this payment, or I'm going to be late, or I don't have enough money to cover it all. What do? Well, I'll just ignore the phone. I just won't do anything. I'll stick my head in the sand and I'll pretend it doesn't exist. And that's the worst thing that you can do, because if you're paying attention to your credit and you reach out to your creditors, you're saying to them, hey, I know that there's a problem, but I'm willing to do something about it. I want to work with you on it. So how does your credit score affect your daily life and ability to achieve your financial goals? We're going to take a look at a scenario here. So Anna and Bella have been friends since middle school. They both own cars. They both have steady incomes to pay their bills. Anna's credit score is 530 and Bella's is 700. So Anna and Bella decide that they want to buy homes in the neighborhood where they grew up. One of them has no problem getting that loan. Unfortunately, the other has a difficult time getting the loan. And when she finally gets her loan approved, her interest rate and insurance premiums are higher than her friends. Well, I think you can probably guess Anna's the one that's having difficulty, and she's going to end up with higher interest and insurance premiums, as opposed to Bella, who has a better credit score. People with bad credit scores have the most trouble getting loans, even though there are other factors that institutions consider. Since Anna has bad credit, her interest rates are going to be higher. And it's also going to impact her ability to get a decent insurance premium. So when you're thinking in terms of things like cars and homes, when you get insurance, your credit history is also going to impact just how much, in along with many other factors, but your credit history does impact the amount of insurance that you end up paying. So credit scores are not the only factor that lenders consider. Factors such as the market, down payment amounts, terms of the loan, whether it's a long-term repay, 30 years, 15 years, and the loan policies of that particular lender can influence how much a loan ends up costing a borrower. But experts and research still prove that one's credit score has a large effect on the cost of a loan. So the better your credit, the lower the final cost is going to be over time. So as you see, credit scores can impact your ability to get a loan, as well as your interest rates and insurance rates. But they also can affect your eligibility for things like a rental home. As many homeowners and property managers check credit scores before renting to someone they don't know. Your credit score can have an impact on many other areas, such as getting a car, because your credit score is taken into account for auto loans if you buy, or it might be difficult to lease a car because they're going to check credit scores as well. And in some cases, employers may do a credit check as well. Basically, that is one way that employers, if they have two people with the exact type of credentials and similar experience, if it boiled down to who has the better credit score, it may be that the employer is more comfortable hiring the person who has a better credit score, because it's an indication of reliability. Here's a person that's repaying their loans on time, making payments on whatever it is that they owe their creditors when they're supposed to. They're fulfilling their obligations. And setting up utilities and phone service. So if you have poor credit, you might have to put a deposit down in order to set up your electric and gas utilities, or to get a landline, or even to get a cell phone. So essentially, anybody that you're seeking credit from may review your credit report to ensure they're lending to someone who's a responsible borrower. Oops. So a lot depends on that 3-digit score. So who actually comes up with the credit scoring system? There are many agencies that prepare credit scores, and they use different models to calculate them. However, the most popular scoring models are FICO, that's Fair Isaac Credit Organization, and VantageScore. So most of us have heard of FICO, F-I-C-O. VantageScore is a little bit more recent, but both of them have been around for a long time. Then there are 3 main credit bureaus in the United States. Those are Experian, Equifax, and TransUnion. So not only do they do a credit score, they also track the credit history. When you opened an account, how you've paid, when it's paid in full, if someone has defaulted on a loan, default means not repaying. So these 3 credit bureaus, they also, along with lenders, use their own version of the FICO or VantageScore credit scoring models. So when you go to take out a loan, if they report to Experian, Experian is going to come up with a credit score, and it might be just a little bit different than what Equifax or TransUnion comes up with. So sometimes they're just a little bit different. It's not going to vary widely, but it could be a slight difference. The bureaus, like I said, keep track of your credit history separately. So you want to make sure that you're kind of getting an idea of what each one has as far as information about you. If you are looking at those credit history reports and there are big differences, you want to get in touch with them and find out what's going on. Now, Again, keep in mind, not every lender reports to all three. They might only report to one, or they might report to two. Sometimes they'll report to all three. But so if you have a car loan, it might show up on Equifax. You might have a student loan that's showing up on TransUnion and Experian, and you might have a home mortgage that appears on all three. That's not terribly unusual. But for like that student loan that's on TransUnion and Experian, they should be pretty similar. They shouldn't be showing, that you're in default on one report and that you're paid in full on the other. So you want to keep track of that. Again, credit scores may also be different depending on the financial product you're applying for, as I mentioned before. Applications for a mortgage might be different than if you're applying for a credit card. Okay. All right. So mentioned earlier that different credit bureaus calculate your credit score in different ways. While the bureaus do not disclose the exact methods that they use, we do know basics. We know some general things that they consider. First, there's payment history. So payment history usually includes looking at whether or not you pay your bills on time. Do you always pay at least the minimum amount? If you do, then you're in good shape. If you make even one late payment, though, it will likely have a negative impact. That's why it's so important that you always pay your bills on time and pay at least the minimum amount when you do so. We always tell folks that if you can afford it, don't let your credit card revolve from month to month. Pay it off at the end of every month, because that is going to make you look better credit-wise. It's also going to save you money because you're not being assessed the interest. The second is the amounts owed. The amount you owe depends on two major factors: how much you actually owe on your credit card or loan. Now, owing money doesn't necessarily mean you're a risk to lenders. The most important thing is showing that you make regular on-time payments towards your debts. Also, if you're an authorized user on a credit card or have authorized someone else to be on your credit card, their payment history will also affect both the card owner and the authorized user's credit scores. So if there's two of you on that credit card, whatever happens as far as payment and usage is concerned is going to impact both people on that card. And I'll talk a little bit about sharing credit a little bit later here. And also, what percentage of your available credit are you using? Typically, people who are using less than 30% of their total available credit are considered a lower risk for a lender than someone who's using 90% of their available credit. Simply put, maxing out your credit card can impact your credit score in a negative way. So let's say you have a $1,000 credit card limit, and let's say you never go above $300 or $400 on that card. They're going to look on that as really much more positive than the person who runs it up to $999 and then is struggling to pay it off. That's really going to be two different things. The person who's running their credit up really high and then struggling to make their payments, their credit score is likely to suffer. Length of credit history. So your credit history is impacted by how long you've been managing credit. So we mentioned earlier that someone who is brand new and hasn't really established any credit, that's one factor. You just have started out. You don't really have much in your credit profile. So you might be a higher risk. Someone who's had credit for 35 years and for the most part has done pretty well managing their credit, they're going to be considered a less of a risk simply because they've demonstrated over time their ability to handle their credit. So even if someone is really good with managing their credit, that shorter credit history is still taken into account. So it's important to build and maintain good credit early. New credit. New credit is credit that you've recently applied for, and that's down at the bottom where my screen may be covering it. It's that little blue square, that little blue pie slice. So each time you apply for new credit, a lender runs a check of your credit score, and it temporarily decreases that score very slightly. It gradually comes back up to where it originally was, but I usually refer to that as kind of a ding in your credits, kind of like ding your car door when somebody opens their car door into yours. It's not that big a deal, hardly noticeable, and eventually, you don't notice it anymore, and it will repair itself. There are, I'm sorry, that also can be a signal, though, if you're applying for credit a lot, if you've got a lot of new stuff out there, it could be an indication that you're trying to use too much of your available credit. And that can be considered a risk because it looks to the creditors like, oh gosh, here they've applied for something else and something else and something else. What kind of trouble might they be in as far as their credit is concerned that they all of a sudden need to access more and more? There are limited exceptions, such as applying for a mortgage. When you go to apply for something large like a mortgage, you might apply for 2 or 3 different ones in a very short period of time because you're trying to get the best score. Well, they're not going to look at that as you trying to access 3 different mortgages. That's kind of considered credit shopping, okay? So that kind of application isn't going to impact in the same way. And finally, types of credit. A smaller portion of your credit score depends on the type of credit you have. So people with a mix of credit types like credit cards, auto loan, and a mortgage may have slightly higher scores than those with only one type of loan, because it's showing that someone has managed their credit over certain needs a little bit more responsibly. Okay, so credit scores are extremely complex and you don't have to worry about how they're figured out. But your actions and everyday decisions can influence your finances. But how about somebody else's actions? Can they affect your credit score? Okay, so Anna's house has gone into foreclosure and she's taken some steps to improve her credit, and now she's been able to qualify for a loan. She wants to use the loan to stop the foreclosure, but she has a problem. She needs somebody to co-sign. Should her best friend Bella co-sign with Anna? And how will co-signing impact her credit score? Well, many people think co-signing on a loan is helpful. It's something that they can do to help a friend or help, especially if that person is your child, a significant other, parent, or somebody else who's close to you. Sometimes married couples or people in long-term relationships decide to merge their finances also. And it's important to know how that's going to impact. So in Bella's case, will co-signing affect Bella's credit score? Well, not necessarily. The loan will appear on her credit report. So now all of a sudden she's got one more loan on there, even though it's not in her name primarily, she's still signing on as a co-signer, because if Anna doesn't repay it, it's Bella's responsibility, okay? When you co-sign, you're promising to repay a loan if the other person does not do so. So if Anna pays her loan on time, it can actually improve both of their credit scores. But if she misses payments or she doesn't repay the loan, this is going to impact both of them negatively, potentially, unless Bella ends up assuming the responsibility of making those payments. Okay, so in the case of people who are co-signing as far as joining their accounts, Michael and Tamika are getting married in 2 weeks. They're thinking about merging their finances by opening a joint checking account and applying for a joint credit card. Tamika has a good credit score, but Michael's isn't quite so good. So should they sign up for joint credit? So, well, many couples choose to get joint accounts because they're convenient. And I will tell you, that's what my husband and I did when we got married. But it's important to remember, even if a couple merges their finances, they still have their own individual credit scores. They will not receive a joint credit score. So Tamika's great credit score is going to remain great, Michael's is going to be what it is right now. So Michael's credit score may not negatively affect Tamika's credit score, but it could affect her in other ways. When they go to apply for a car or house together, lenders are going to evaluate both of their credit scores, and it may end up getting a higher interest rate because Michael's score is not as good. And that's not always the case. Some lenders are only going to look at the highest score. I know when my husband and I went to apply for a home equity loan, they looked at the highest credit score and they went with that one. But it's important that you're aware that a partner's poor or bad credit score may affect the amount you pay in some cases down the road. So applying for a credit on your own or with someone else can impact your credit score. So you want to be mindful of your own credit score before making any decisions to co-sign a loan or merge your accounts with someone else's. Their actions, like not paying back a loan or paying late, can damage your credit. Also, their credit score can impact the cost of financial products for the both of you. Adding an authorized user to a credit card is also a common way to share credit. But again, keep in mind that the primary cardholder is responsible for paying the bills. So if any of you are on a parent's credit card and you're responsible for paying your portion, keep in mind that you're building your own credit, but you could be hurting your parents if you don't pay it back on time. Or if you don't make those payments, or if you run up a credit bill that your parents really don't want you to. If you both use the card responsibly, it can increase both of your credit scores. Again, keep in mind, adding an authorized user can be a risk for the primary card holder if that additional person overspends. All right, so we've talked about credit scores, but what about credit reports? How are they different? So basically, your credit report is a snapshot of your credit profile, including your credit history, how you've paid, what you've borrowed, whether or not you've paid it back on time or in full. Credit reports help lenders, such as financial institutions, understand how credit worthy you are. That is, whether you're likely to repay a loan if you are given one. All right. So it's important that you review your credit report on a regular basis. It's one of the tools that will help you to build and maintain good credit. There are three, like I said, three nationwide credit reporting bureaus. They calculate your credit score based on the factors that affect it. Now you want to keep in mind, a lot of times people say, well, oh, don't check your credit because it'll lessen your credit score. That's not true. Keeping an eye on your credit report can help you in many ways. It can help you detect fraud and maintain or work toward a better credit score. You can get one free credit report from each of the three credit bureaus each year online or by phone. So what you want to do is go to that website, annualcreditreport.com. That is the only website that is federally authorized to give your credit report for free. And you can get all three of them at once by either going on that website or calling that phone number. You can also, instead of doing it all at once, you can do three of them all spread out. So maybe do Experian in May, Equifax in July, and TransUnion in October. That way you spread out over the year when you're getting your credit reports, and it helps you to track things a little closer. There are some situations where you can get a free credit report in addition to that one time annually, and that is cases of reported fraud. So if someone stole your credit or stole your identity, you can also get additional reports. If you need to apply for some sort of public support, or if you're denied a loan or denied a credit application, in those cases, you will be able to get an additional report because you need to check why you were denied. All right. And you want to also, if you're unemployed, but plan to look for work within 60 days, you can also get an additional copy. The one where if you've been denied a loan, credit insurance, or employment, and you have no idea why, you definitely want to look at your credit reports. I was getting ready, my husband and I were getting ready to take out a home equity loan. And in preparation for that, I pulled all three of my credit reports just to see what was going on and discovered that I had something on there that was not mine. Someone had accessed they had actually stolen my identity. And what I had to end up doing was going through all the steps that you have to go through in order to get that rectified. Part of it is filing a police report. Even though it was online, I had to file a police report. I had to contact the credit reporting agency. In this case, I think it was Experian. I had to reach out to them and say, hey, my identity's been stolen. I had to provide them with my information. I had to reach out to the creditor, in this case, T-Mobile, and say, hey, somebody took out a cell phone in my name. And the other thing is that it wasn't even actually my name. They only used part of my name. So I had to do all that, and eventually it was expunged from my credit report. But thank goodness I had done this a couple of months before I was planning on taking out that home equity loan, and it actually delayed me getting that loan a little bit. So that was kind of a pain. All right. So credit scores, unlike your credit history, are not currently included in the free credit reports available. You can get your credit score by requesting it from one of the three credit bureaus, but they are going to charge a slight fee. All right. So once you've requested and received your credit report, what do you do with it? Well, your credit report is going to contain 4 major sections. You want to look at each one and make sure the information in there is correct. If you see anything that is inaccurate or weird or suspicious, you want to reach out and get those corrected. So public records, if you've had lawsuits or bankruptcies, any judgments made against you, say you didn't pay a bill and it got sent to the court and the court ruled in the creditor's favor, that's going to show up there. Delinquent or unpaid taxes. Credit accounts, so your debt status, what debts do you owe, what loans have you taken out, any opened and closed accounts. So if you had a Bank of America credit card at one time and you closed it, that's going to show up there. You want to make sure that if you close an account, that it's reported on your credit report as closed by consumer or closed by the person who took out, it's closed by you, not by the creditor. Because closed by a creditor means that they've closed it because you didn't pay it and they had to write it off. So basically, you want to make sure that it's accurately reported. Personal information. So it's going to include your name, birth date, social security number, your address, and the name of your spouse and your employer. So you want to keep in mind that when you get this credit history, your credit report, this needs to be stored someplace where it's very safe because it's got all of your personal information. Okay. And then any credit inquiries. Anytime that you have applied for any kind of credit or asked that your credit be used to verify you in the past 2 years. So if you applied for a student loan, if you applied for a credit card, all right. Things that will not appear on here on the credit report include medical information, any information about religion, race, or gender, any information about your checking or savings accounts, information about any debit or prepaid cards, and any private loans you've received from anyone such as friends or family or anyone else. So those things will not appear on it. So requesting and reviewing the information on your credit report is the first step towards maintaining and building healthy credit. What are some additional things you can look at? So the date the account was opened. Remember I mentioned about length of credit history? That's important. Any dates of delinquency, and they will go back 7 years, all right? Any dates of public records. So bankruptcies, student loan defaults, all of those will show up there as well. Any kind of legal activity is erased after 7 years. Bankruptcies will stay on there for 10 years. Any dates of credit requests. So anytime that you've reached out to apply for credit, it's going to show up and it's going to show the dates. If you notice any errors, you have to dispute the errors with credit bureaus. There are credit repair companies, but before you choose to go with something like that, you want to know your rights. So the Credit Repair Organizations Act was established to ensure that your rights as a consumer are protected. It prevents credit repair organizations from engaging in false advertising and deceptive practices that may harm you. All right. So in other words, credit repair organizations, they cannot overpromise to delete all bad credit, regardless of whether it's legitimate or not, because that's not really true. All right. So let's say you have some bumps in the road with your credit. So what are things that you can do to repair it? The first, you want to make sure that you are making on-time debt payments. Anything that you owe, make sure you're paying it on time. Also, make sure that you are paying at least the minimum amount. And if you need help with creating a new repayment plan, reach out to the lender because they may be able to work with you. Okay. The second is inform credit bureaus and companies that provided information to bureaus that if there are any errors, you want those erased. Okay. You'll need to include the following: a copy of the credit report, a list of what's disputed, the reasons for disputing it, and copies, not originals, but copies of any documents that support your request for correction. So if you have a letter from someone saying that you didn't need to make a certain payment, but then you got dinged on your credit report for not making that payment, okay? The credit reporting agencies have to respond back to you within 30 days. All right. And you want to, anything that you send by mail, you want to send by certified mail and request a return receipt. All right. So if you've been through anything like a bankruptcy, foreclosure, or divorce, there are also steps you can take to reestablish credit. All right. Monitor your credit report and scores. Again, pay your bills on time and regularly. Reach out to a credit counseling agency, and there are some out there. Not-for-profit agencies advise people about money and debt management. They help to create financial plans and offer workshops. Usually, a lot of them are free. You always want to look for things that are free. Consider other financial products. Getting a secured loan or credit card might help to build your credit. Again, there might be trade-offs with that, fees or minimum deposit amounts. And you want to make sure that you understand everything. You know, you sign off on many things. Don't sign on the dotted line until you understand what you're signing. Credit repair scams. This talks about Anna. Her house falls into foreclosure, and she looks at several credit repair companies. The first one promises to remove all bad credit from Anna's report. All she has to do is pay an upfront fee. Now, Anna's very worried about her debt, but the company says, you know, we can take everything that's bad off of your report. They also tell her not to report the credit bureaus directly, since doing so will negatively impact their efforts. So there's a number of red flags there. First of all, they can't remove all of her bad credit information. It's just not possible. If it's bad credit because it's an error, that's true. If it's bad credit because she hasn't been paying her bills, they can't remove that. You also don't want to pay somebody up front because you never know if they're fly-by-night or not. And also, you should be reaching out to the credit bureaus directly because they're the ones that are going to fix the situation with you. All right. So those are all the things that I just mentioned. Other signs of a credit repair scam are asking for signatures on blank paperwork. Let me tell you, if anyone ever asks you to sign something that's blank, run in the opposite direction because it's probably going to be a scam and it's not likely legal. Credit profile number scams and fake Social Security scams. So, you know, we've been getting a lot of calls from Social Security saying that your Social Security number has been blocked. it's a scam. So please be careful when people send emails or texts. Check who the email is coming from. Is the text actually from your bank? And do banks really send texts? So just be very careful about the information that you provide to anybody, because there are scams out there and they are looking, a lot of companies looking to steal your identity. Okay. Credit counseling services include the National Foundation for Credit Counseling, that's nfcc.org, and Financial Coaching Association of America, fcaa.org. These are two organizations we're not endorsing or anything, but these are two organizations that may be able to assist if you run into any trouble and need help with poor credit, reestablishing good credit. Okay. So strategies to improve your credit. Never use more than 30% of your total available credit. Never max out a credit card. Always pay everything on time. Again, pay off your credit card bills each month in full if it's possible. And if it's not possible to do that, if you had a large expense and you need to break it down, pay it off as quickly as possible. Make that a priority. Pay off loans on time. Do not take out multiple loans and credit cards all at the same time, because that looks like you're in desperate straits for credit. And create a financial plan and follow your monthly budget. Writing down your budget is really one way that you can make sure that you're following what your money allows you to follow as far as a budget is concerned. Okay. So it's important to review your credit reports regularly, and you can request them for free at annualcreditreport.com. Your credit score is a reflection of your debt management practices, and also to some degree your reliability as a person taking out credit. You should always pay your bills on time. Never default on a loan. That means just ignoring it and walking away from it. Never ever do that. And it's possible to repair bad credit by managing debt and credit responsibly. All right, I flew through a lot of information very quickly, I realize. What questions can I answer for you?
Yes, so if you have any questions, feel free to put them in the chat. This Q&A session is being recorded, so unless you're okay with having your voice recorded, we ask that you put your questions in the chat, in which some are already there. So one question is, if there is only one organization that is federally approved for sending credit reports, how are companies like Credit Karma allowed to advertise giving people credit reports for free? Are they significantly less reliable than the credit reporting agencies you've already mentioned?
I will be honest, I am not as familiar with how those companies work. They're giving you the same information, but the thing is, I don't know if they're giving it to you in the same format. So that's the reason we tell people to use annualcreditreport.com, because if you're pulling your credit history once a year from there, you know that you're getting it directly from those sources. And I'm not saying that Credit Karma and those companies are not legitimate. I don't think they'd still be in business if they weren't. But they may not be providing the same format and the same information. So I think that those companies kind of give you a summary, and I'm guessing this. They kind of give you more of a summary than what you're getting directly from each credit bureau directly. So that may be why they're able to just give you that information. And honestly, you know, my bank gives us a credit score for both my husband and myself every month. I can look that up. When I look up my information on my credit card, they give me my credit score. So I have an idea of where my credit score lies, but exactly how, I have to admit, I'm not really as familiar with the Credit Karmas and those sort of companies. So my assumption is that they may not be giving it to you in the exact same format. And I'm not saying it's any less legitimate. It's just they're giving it to you a little differently.
All right. Let me look back in the chat. Okay, so another question that we have is, do you know if there is a bit of credit score inflation due to the different companies competing for consumer attention?
I have to say, I don't know, but I'm not sure that that's something that goes into credit scoring. That's not something I've heard of before. So I really honestly don't know. Can you give me that question again? Because I can ask someone and get back. I can get back to Madison and ask her to reach out to the person that had that question. So credit scoring inflation due to what?
The different companies competing for consumer attention.
My best guess is going to be no, but I am going to ask that question and see if I can't get a good answer and get it back to Madison. So Madison, if you can get that person's email address for yourself, and I will get that back to you within, I would say, before end of business tomorrow.
Okay, great.
That's a good question, though.
Okay, so some other questions in the chat are, you mentioned about how the credit score might not be exactly the same depending on who you get it from. So how much can you expect that credit score to vary? Like with how many points?
It's not going to be, I mean, it's not going to be like a difference of 750 to 800. I would think at most somewhere between 10 and 20 points usually. They're usually pretty close. When I'm thinking about what mine are, I think mine are off by about 10 or 20, depending on what the source is. And again, it depends on where you're looking. The bank, where I have my checking account has one number. But I don't actually have a loan with that particular institution in the moment. My one credit card has a different score, but I think they use a different credit bureau than I only have two credit cards, by the way. And actually my husband and I only have two. But one credit card has a slightly different number, but even looking at those two, none of them are more than 20 points off. And again, credit cards are looking a little differently too, because they're credit cards. And remember, I made a comment about depending on what type of credit you're accessing. So they might be looking at the fact that that's unsecured. So maybe my credit score there is a little bit lower than what something else, another institution might come up with, because, I might have a different credit score with my home equity lender.
Okay,
but they really shouldn't be vastly different.
Okay. Another question in the chat is, so you talked about the idea of never using over 30% of your credit limit. So somebody asked, if you do use more than 30% and get closer to that credit maximum, but you pay it off immediately and don't have trouble keeping up with the payments, will getting to close to that maximum amount still negatively impact your credit?
It could ding it. Now, again, I'll use the example of me. We used a lot of our home equity loan because we purchased the home that we're going to be moving into. My brother and I both owned the house that my father lived in until he passed away a couple of years ago. So I bought my brother out, and we're going to be moving into this house. So that's the reason I took out the home equity loan. So I'm real high up on that limit, and I'm paying it on time. So I did see my credit score kind of tweaked down a bit, because they were like, oh my gosh, you're at this horrible amount percentage wise. but I'm also not using any other credit. I use my credit card to pay it off. So I'm at this horrible percentage of all of my credit, but it's also going to get paid off at some point, and I'm paying the bill. So yes, if you have to do something crazy like I've had to do while we're waiting to sell our house that we used to be living in, it is going to it did ding my credit. But they're also looking at the fact that I pay my home equity amount every month. I pay off my credit card every month. I pay all my bills on time, all those things. And also the fact that I've had credit for, 30 some years, those all come into play. Now, someone who's 25, if they took out 85% of their total credit, that might dip it quite a bit more, because the creditor doesn't have as much to look at. They're saying, oh my gosh, this brand new person to credit has taken out this tremendous loan. What the heck were they thinking? Well, it happens. That credit score is probably going to dip a little bit further than maybe mine did, because the person has less credit history. It's not saying that a younger person is more of a credit risk. We are all credit risks at some point in our lives. And I will tell you, we've all made mistakes. I wrecked my credit score when I was 19 years old with $100 credit limit. So it can be done, and it can be undone. But yeah, I mean, if that happens and it's paid down quickly, or if it's being paid regularly and paid, in more than just the minimum amount, that certainly is going to lessen the ding to the credit score.
Okay, thank you.
Mm-hmm.
Another question from the chat. This is relating to what you said about credit being an aspect of determining employment. So they asked, what is the likelihood of people using credit to determine whether they should hire you or not? At what point does it become more significant, and how significant is it in comparison to other aspects?
Well, like I said, it's used okay, let me back up. It's not used in every state. I believe that Maryland actually has a law that says that employers cannot use the credit history or credit score when determining employment. I think that's fairly recent. But my understanding is that Maryland is one of those states. So not every state permits that, because it's kind of seen as it's not very equitable. I'll put it that way. The whole idea of equity, it puts a lot of people at a disadvantage. So that's one thing. But when the reason that it's used that way is, I've got two 24-year-olds who've come and applied for a job with me. They both have a year's experience in their field. They both are coming with very wonderful recommendations. They both have the same education. How do I choose between them? And in some cases, employers have used credit history or a credit report as a way of saying, I have two perfect candidates. What's going to raise the boat a little further on either side? And so they've used credit, because credit is considered a determination of reliability. But not every state permits employers to do it. Not every employer does it. But if you are young and just starting out and just putting your credit together, that's just one more reason to incentivize yourself to do everything you can to keep your credit score good. And one of the ways to do that is use credit cards as little as possible, have as few credit cards as possible. Remember, I said my husband and I have two, and there's a reason for that, because that way you don't get in trouble with them. So.
Okay, thank you very much.
You're welcome.
Does anybody else have any other questions? All right. Well, if there are no more questions, thank you so much, Ms. McSweeney.
Thank you all for for allowing me to come out and share information with you. I will reach out about that credit score inflation question and get back to Madison as quickly as I can today.
Okay, great. Thank you so much. So I'm gonna stop the recording.